I'm Christoph Heuermann from denationalize.me, and today I'm making a video for you on the subject of tax certificates. Some people also refer to it as a tax residency certificate, or something similar. In short, the tax certificate is a big myth for many. Many people think they need it even though it isn't necessary. Others don't have it, even though they actually need it. That's why we want to clarify in this video in what cases you actually need a tax certificate. Where can you actually get it particularly easily? Yes, the tax certificate itself is there to prove your tax residency in a country. It is also called a residency certificate. In other words, the state tells you that you are liable to pay taxes in that particular country and that you are generally only liable to pay taxes in this country. This is also the reason why in most countries the tax residency certificate is only issued after 183 days of residence. In other words, you'll be there for more than half a year, so you can't be in another country for more than half a year. The tax residency certificate is issued accordingly. The tax residency certificate is more or less important depending on the country. As Germans or Austrians or Swiss who emigrate, we do not need a tax certificate from a new place of residency in order to get out of the old tax liability. In principle, not in Germany or Austria. Here it is enough to deregister and then leave the country. The day of departure is basically the same as the end of unlimited tax liability. In Switzerland, a new proof of residency, a utility bill, tax number or similar is sometimes required, but not necessarily a tax certificate. In other countries, however, it is often the only way to end tax liability. For example, if you have unlimited tax liability in Spain and want to emigrate, you must have a tax residency certificate in order to avoid Spanish tax liability. As long as you cannot provide this tax certificate to the Spanish authorities, you will not be able to get out of Spanish tax liability and will continue to have to pay taxes in Spain. You should keep this in mind when emigrating to such countries. In many other countries, you can get out of tax liability even without a tax certificate, but only after the end of the tax year. And such a tax certificate can help to establish a new tax residency in another country during the year, especially if there is a double taxation agreement between the new country and the old home country. In principle, we don't need the tax certificate to emigrate from Germany or Austria or company. We only need it to emigrate from other countries. However, we may need all of this if we want to return to Germany or Austria. There are basically the following regulations when returning. Of course, you can always return, but this can have unpleasant tax consequences, especially if you haven't emigrated for the long term. Basically, you can say that in Germany and Austria, if you have emigrated for more than 2 years, you have emigrated long term. And under this circumstance you can come back at any time without having to pay any additional taxes. So if you just do perpetual traveling for 2 years, you can come back at any time. No problem. You go to Germany, register, pay taxes there, and can easily bring the money you earned tax-free over the past 2 years with you. Easy is to be put in quotation marks because there are of course other regulations, for example proof of assets. If you want to invest in real estate, you may need to be able to prove where your money comes from if you don't have a tax return. That might not be so easy. But basically the state can't tax you if you come back after more than 2 years. Below the 2 years, especially if you only emigrated for 1 year, there is a risk that you will be subject to additional taxes if you cannot prove your tax residency with such a certificate in the meantime. In other words, if you only want to emigrate for a year or two, for example to sell your shares tax-free or something similar, then you should have and be able to provide proof of tax residency. Otherwise there may be problems when returning to Germany. May or may not. Not everyone who comes back to Germany has problems. But especially those who already have a lot of assets or income when they emigrate, are often asked when they return after only a short time, where they have paid taxes in the meantime. From the point of view of emigration and re-immigration, why do you still need a tax certificate? Basically, in order to use double taxation agreements. Double taxation agreements can be used in many ways. We don't want to talk too much about it in this video. But an important point, for example, is the use of treaty benefits. For example, if we are a stock investor who invests in dividends, then in the USA we have a withholding tax of 30%, and 35% in Switzerland. In both cases, as private persons, we can reduce this to 15% with a double taxation agreement. To do this, we just have to be a tax resident and submit this tax residency to the states. In the USA this happens automatically via the W-8 form, which we fill out at the broker. But in all other countries, for example Switzerland, we have to manually apply for this 20% withholding tax to be refunded to us. In this application we must enclose our tax residency certificate, which guarantees us that we have tax residency. This means that anyone who is affected by a withholding tax, especially in the area of dividends on shares or company investments, in the area of interest or in the area of royalties, should have a tax residency certificate. The tax certificate is not only available at private level, but also at corporate level. This means that it can certainly be a solution to give your assets, for example shares, to a company because a company does not have regulations for requiring a tax certificate. Companies only need a place of operations, and in rare cases an employee, to use double taxation agreements. As a private individual, this tends to be more difficult because you have to be in a country for more than 183 days, with exceptions, which we'll get to. The tax certificate is also important in all other tax-relevant cases of inter-country nature, such as those who under the old regulations from 2021 will still have to defer exit tax because they have moved within the EU. They also have to prove their EU residency to Germany every year via tax certificate so that the exit tax does not apply retroactively. Or in the current case, for example, anyone who is involved in German limited liability companies and wants the 25% withholding tax back from Germany, must prove that they also have their tax residency in the country where they have the holding company. So-called personal relief entitlement, to actually get the 25% back. And in all these cases the tax certificate is very relevant. But it's not relevant if we just want to emigrate from Germany. Then we don't have to prove to the tax office that we have a new tax residency using this tax certificate. As I said, in almost all countries you only get the tax certificate after 183 days, but there are certain exceptions. For example, Cyprus is known to issue tax certificates after just 2 months, under certain conditions. And also some other countries, which we will discuss in a next video. So this video is an overview. What is a tax certificate? What do you need it for? And in the next video we'll look at countries where you can get the tax certificate, if you need it, even with a stay of less than 6 months. So much for that and see you in the next video.